University of Buckingham, Money, Banking and Financial Markets, Summer Term, July to September 2020. Again, before we start the lecture, just the slide to tell you that the student experience is still here for you with all the details you'll need for the Students' Union, the Career Service, Student Conduct and Student First, all available despite being on online teaching. These services are still here. Lecture 4, we will be looking at central banks. Contents of Lecture 1 will be history and structure of central banks. We will then look at central banks and the money supply. Then we will look at the goals and strategies of central banks. First, let's look at the history and the structure of central banks. Origins of the central banking system, which is now pervasive throughout the entire world. The Sveriges Riksbank, or the Bank of Sweden, was established in 1668, with its main function being to lend money to the government of Sweden. Rise in global trade increased the volume of international payments in the 17th century, hence the need to create more central banks throughout Europe to monitor and control the payments between countries. The founding of the Bank of England in 1694 marks the de facto origin of central banking, a couple of years after the foundation of the Bank of Sweden. Gradually, the central bank's functions have evolved from being the main lender or financer of governments to safeguard monetary stability, which has required central banks, even when not nationalised, to answer to parliaments and governments. In the United States, the Federal Reserve System was set up in 1913. This was the final of a number of attempts to set up a central bank in the United States, but the Federal Reserve System was finally set up, designed to distribute power over 12 regional Federal Reserve banks, and remained privately owned by its member banks. Initially, most emerging market economies established their central banks after World War II, and the structure of these banks became similar to those of the European central banks. Over the last 2 centuries, the functions of central banks throughout the world has expanded to regulate the value of the national currency, financing the government, acting as a lender of last resort to banks suffering from liquidity and or credit crisis, to regulating the financial system, and now increasingly, in the last couple of years, banks have been concerned about the impact of climate change on the financial system. Who should own central banks? Should they be private or they should be public? The arguments for public ownership are that central banks act ultimately in the public interest. They're providing in a sense, a public good, a stable money supply. Private ownership would bias central banks towards self-serving profit-making interests, towards increasing risk-taking and potentially having balance sheet troubles. The global financial crisis highlighted the concerns that the profit-making target of private shareholders could hamper them from saving the financial sector during financial crises. One of the arguments for private ownership guarantees central bank independence. You can restrict the distribution of dividends per share, and private owners are required to recapitalise the central bank in case of losses, which lifts the budget of the public fiscal budget. Variations in the functions and structures of central banks. While the role of central banks has grown in importance as their activities have evolved over time, but there are significant differences in the structure and policy tools that each central bank adopts, and this depends on the level of sophistication of the banking and financial sectors and the independence of the country in terms of monetary policy, which is related to whether or not the currency is pegged against the dollar or some other currency. Central banks have taken on increasing responsibilities which require more independence from fiscal authorities and from political institutions. It's worth looking at the work of the Bank of International Settlement, which is the bank and borrow, which is actually acts for most central banks. We'll now focus on a bit more detail on three central banks: the European Central Bank, the Federal Reserve, and the Bank of England. The European Central Bank came into existence on the 1st of June 1998 to handle the transitional issues of the nations that comprised the Eurozone, those countries which adopted the euro as a single currency. The Eurozone is an economic and monetary union consisting of the member states of the European Union that have adopted the euro as their currency. The creation of the Eurozone and of the new supranational institution, the European Central Bank, based in Frankfurt, was a milestone of European integration. All of the member states of the European Union who are members of the Eurozone have to comply with a set of economic and legal conditions. In January 1st, 1999, only 11 EU member states had met the conditions to adopt the euro. All of the Eurozone or Euro area countries, EU countries have adopted the euro, retain their own national central banks, the Bundesbank in Germany and so on, the Bank of France, and their own banking systems. But the European Central Bank handles the common currency. As of 2020, 19 countries out of the 28 member states of the European Union have joined the Eurozone. So the Euro system as a whole comprises the European Central Bank and the national central banks of those EU member states have adopted the currency. How is monetary policy conducted within the European Central Bank? Well, the three main objectives of the ECB are to maintain price stability in the economies of the EU, using a harmonised consumer price index as a target, which is 2% inflation, support the economic policies of the Eurozone nations, and ensure the maintenance of an independent and open market economy across the zone. As price stability is important for attaining economic growth and job creation, the ECB endeavours to maintain its independence from the governments of the European Union, which of course makes it a little bit complicated because the euro, unlike the dollar, is not backed by a single government. As we mentioned, the ECB was established in 1998, headquartered in Frankfurt, Germany. In 1999, member states of the euro area, including Germany, ceded monetary and currency control to the ECB, and the ECB was very much crafted in the manner of the Bundesbank. The Bundesbank size is still influential in the crafting of the Eurozone's monetary policy in terms of a commitment to fight inflation if necessary and a commitment to 2% inflation rate. During the European sovereign debt crisis 2010 onwards, more than 5 bailouts were offered to the ailing European economies, and the burden of these, of course, lay mainly on the Bundesbank, given its size. Many times the Bundesbank was at odds with the European Central Bank, protesting that the monetary financing of budget deficits violates the ECB's independence from government's political and financial influence. And these tensions remain. To achieve its primary objective of price stability, the ECB aims to maintain a medium-term inflation rate closely below 2%. The Governing Council of the ECB sets the following 3 key policy interest rates as part of their monetary policy. The deposit facility rate, which is the rate on tenders to banks. It's the most important policy rate because it provides the bulk of liquidity to the banking system in the countries which are part of the Eurozone, and determines how far down the ECB's quantitative easing programme, which is aimed at pushing down sovereign bond yields to support the system, how far this can actually create liquidity in the system. The second is the refinancing rate, which is the rate on overnight deposits with the Euro system. And finally, the marginal lending facility rate, which is the rate on overnight credit granted to banks from the Euro system. The ECB's open operational framework consists of the following set of fairly conventional monetary policy instruments. Open market operations, which is buying and selling financial assets, mainly bonds, from or to banks and other financial institutions. Standing facilities provided to absorb or supply overnight liquidity to the banking system, and setting minimum or required reserve requirements for credit institutions within the Euro system. Since September 2008, the ECB has introduced a number of unconventional or non-standard monetary policy measures to complement these regular operations of the Euro system, when standard monetary policies become ineffective at combating a falling money supply and attempting to counteract an economic recession. And there's a history of these, and a history of the quantitative easing programme of the ECB. The unconventional monetary policy measures include an emergency liquidity assistance, ELA, that provides liquidity and loans exceptionally to solvent banking and financial institutions that are facing temporary liquidity problems. Quantitative easing, where the central banks buy sovereign bonds and other financial assets from commercial banks and financial institutions to increase the money supply and stimulate the economy. Note that the ECB cannot buy sovereign bonds directly from the governments. They can only buy them indirectly. Examples of these include the asset purchase programs and the securities market programs. The APP includes purchases of public sector securities and private sector bonds and asset-backed securities, while the securities market program strictly limits purchases of government bonds by the Euro system to secondary markets. The non-traditional monetary policy tools, which we talked about above, were meant to be temporary and aimed at providing liquidity to the financial markets and reducing pressures on interest rates following the financial crisis, subsequent recession, and the sovereign debt crisis sparked off by the problems with Greece. Since 2014, the ECB has introduced a negative interest rate policy on bank deposits in order to reduce the slowdown in the economies of the Eurozone. The ECB itself doesn't conduct monetary policies, but assigns these tasks to the national central banks. For example, in the case of the quantitative easing programme, the 19 national central banks are tasked with the function of buying bonds in their respective sovereign bond markets. Let's look now at the Federal Reserve System. The Federal Reserve System, also known as the Federal Reserve Bank, or the Fed for short, is perhaps the largest and most influential of central banks in the world. The Fed is an independent entity that is privately owned by its member banks. The Fed is subject to oversight from Congress, the legislative body of the United States, and it periodically reviews its activities. The Fed supervises and regulates the nation's financial institutions and simultaneously serves as their banker. The Federal Reserve Bank of New York, and it's worth looking at their website, plays a special role in the Federal Reserve System for several reasons. First, its district contains many of the largest commercial banks in the United States, the safety and soundness of which are paramount to the health of the United States financial system. And the second reason for the New York Fed's special role is its active involvement in the bond markets and the foreign exchange markets. The Federal Reserve System consists of the following parts: the Federal Reserve Board of Governors, which mainly assumes regulatory and supervisory responsibilities over member banks; the Federal Open Market Committee, which comprises 12 members, 7 members of the Federal Reserve Board of Governors, President of the Federal Reserve Bank of New York, and 4 of the regional Federal Reserve Bank presidents. And here's some information if you want to look at it. And the Open Market Committee convenes 8 times a year to decide on interest rates and monetary policy. And these meetings the results are the minutes are published, and it is closely watched in the financial markets. The 12 Federal Reserve banks are located in major cities throughout the nation, private US member banks, and the Federal Advisory Council. Both the European Central Bank and the Fed are entities that bind a number of regional central banks together: 19 national central banks for the ECB and the 12 regional Federal Reserve banks for the Fed. Again, it's worth looking at some of these regional Federal Reserve banks, and quite often there's very useful information or articles published. Both are independent institutions with a decentralized structure. The ECB supports political independence and makes monetary policy decisions independent of political authorities. The Fed is highly independent of the government and reports to Congress, although decisions by the Fed are quite often criticised by the President, particularly the current incumbent. Important differences exist, however, between the structure of the Euro system and that of the Fed. The primary objective of the European Central Bank, given the influence in its formation of the Bundesbank, is to achieve price stability. On the other hand, the Federal Reserve's dual mandate and monetary policy objective is to deliver price stability and also to support the macroeconomic objectives of the economy, including those of supporting growth and employment. The Fed often ignores temporary effects of price changes, since it considers high unemployment to be a much bigger priority. So there may be some price increases which would signal a rise in interest rates, but quite often the Fed has ignored these because of the underlying unemployment in the economy. The budgets of the Federal Reserve banks are controlled by the Board of Governors, whereas the national central banks in Europe control their own budgets, and the budget of the ECB in Frankfurt. The monetary operations of the Eurosystem are not centralised but conducted by the national central banks, as we said, while the monetary operations of the United States are centralised in the Federal Reserve System. The ECB is not involved in supervision and regulation of financial institutions, as these tasks currently are left to the individual countries in the European Monetary Union, while the Federal Reserve is involved in these areas, although of course there are plans to create a banking union. In financing fiscal budget deficits, the Federal Reserve buys government bonds outright, while the ECB accepts them as collateral for new loans to the banking system. Let's look now at the structure of the Bank of England. The Bank of England is the central bank of the United Kingdom. Has been called the Old Lady of Threadneedle Street, and it was founded in 1694. As the second oldest central bank in the world after the Swedish bank, the Bank of England model has been the basis for most of the central banks of the world, especially those in Commonwealth countries. The Bank of England is accountable to the UK Parliament. As the United Kingdom is not a member of the euro area, the Bank of England makes its monetary policy decisions independently from the ECB. The bank's Monetary Policy Committee is responsible for conducting monetary policy. It has 9 members, of which 5 are Bank of England staff, and 4 members of the committee are independent experts chosen from outside the bank. The MPC meets over 3 days, 8 times a year, to deliver price stability and to support the government's economic objectives, including those for growth and employment. The interest rate is the main policy tool that the Bank of England uses for controlling growth, currency, other aspects of the economy and inflation. However, as interest rates were cut close to zero since the global financial crisis in the United Kingdom and many other countries, many central banks, including the Bank of England, have used quantitative easing as an unconventional supplementary form of monetary policy. Quantitative easing aims to directly increase private sector spending in the economy and return inflation to target, not to actually decrease inflation, but to try and increase inflation up towards 2%. Quantitative easing works, as we'll see later, through increasing liquidity in the banking system in the hope that this will expand the money supply, deposits and lending. The government's inflation target is announced each year by the Chancellor of the Exchequer in the annual budget statement. The minutes of the Monetary Policy Committee meetings are published simultaneously with the interest rate decision it makes. This gives the Bank of England much less autonomy in comparison to the Federal Reserve. We'll turn now to the issue of central banks' independence. The Bank of England was only made independent in 1997. The European Central Bank was independent on its creation, and of course the Federal Reserve was independent in 1913 which was created. But during the last 4 decades, both theory and empirical evidence have suggested that monetary policy tends to be more effective when the central bank is more independent. And increasingly more central banks have been made independent since the 1990s. There are 2 key dimensions of central bank independence: independence of goals, which encompass the institutional characteristics that insulate the central bank from political influence and define its monetary policy objectives. In other words, central bank doesn't have politicians leaning on it, telling it to reduce interest rates or stimulate the economy, when it's perhaps unwise to do that because of inflationary pressures. Instrument independence, which refers to the ability of the central bank to freely implement policy instruments in pursuit to meet the monetary goals. In other words, to decide what range of policy interest instruments they can use, interest rates, open market operations, quantities, and so on. What's the case for independence? We mentioned potentially inflationary biases that are likely to exert themselves as a result of political pressure to boost output in the short run, and this tends to lead to a political business cycle in which these expansionary monetary policies are reversed after the election to limit inflation, leading to booms and busts in the economy, or even worse, accelerating inflation. The public generally distrust politicians in regard to making politically motivated decisions and their lack of expertise in conducting monetary policy. The case for independence as well. Politicians often opt for more central bank independence when there is a disagreement between policymakers regarding unpopular macroeconomic decisions. In other words, you can blame the central bank. The politicians grant more independence to the central bank in order to avoid public criticism. This has been the case in many emerging market economies that were forced to float or liberalise their domestic currencies in order to integrate with global financial markets, and at the same time many granted independence to the central banks to follow policies which were necessary for the currency but did not always find popular accord. The case against independence. Macroeconomic stability can best achieve monetary policies properly coordinated with fiscal policy. As we've seen since the financial crisis, there has been fairly loose monetary policy in the United Kingdom and in many other countries, but fairly tight austerity fiscal policies, particularly in Britain and very much in Germany, whilst the European Central Bank has been pursuing very, very loose monetary policy. As the government is responsible for the country's macroeconomic performance, therefore it must have some control over monetary policy. That's the argument. Central banks are not, of course, immune from political pressures, even when they're independent, and the theory of bureaucratic behaviour suggests that the objective of a bureaucracy is to maximise its own welfare. Just as in the case of a consumer, behaviour aims to maximise personal welfare. This is what comes out of the public choice literature. Thus, the central bank can pursue a course of narrow self-interest to increase its power and prestige at the expense of the public interest, and of course when the central bank is responsible also, as the Bank of England now is, although it wasn't for a short period of time, for regulation of financial institutions and banks, there's the danger of regulatory capture. But there has been a trend towards greater independence. The high correlation between macroeconomic and price stability and central bank independence has led to the trend to enhance central bank independence globally, and this has actually happened in the last few decades. To ensure that central banks do not deviate from their socio-economic goals, most central banks are made accountable to their parliaments and required to become more transparent about their operations even when they are independent. While the Federal Reserve has historically been more independent than most other central banks, the structure and the level of political independence of the European Central Bank, with there being no European government, makes it even more independent than the Fed. The central banks that are traditionally subject to the intervention of the Ministry of Finance, such as the Bank of England and the Bank of Japan, have been granted more independence in the 90s, the Bank of England in 1997. The Bank of England is among the most independent central banks with regard to the central bank's function of bank regulation and supervision. The Bank of England has formed the Financial Policy Committee and invited a non-voting member from the UK Treasury. Conversely, the US Financial Stability Oversight Council comprises all of the principal regulators as members and the Secretary of the Treasury as chairman. We'll now look at central banks and the money supply. In this, we will look at the three players that influence the money supply in any economy, particularly the United States. We'll concentrate on. Classify the factors affecting the Federal Reserve's assets and liabilities. Look at the factors that affect the monetary base and the economy, and discuss their effect on the Federal Reserve's balance sheet, and explain and illustrate the deposit creation process using T accounts. We'll list the factors that affect the money supply, summarise how the three players can influence the money supply, and calculate and interpret changes in the money multiplier. So how are the three players in the money supply process in the United States? The central bank, which in the United States is the Federal Reserve System, commercial private banks, depository institutions, financial intermediaries, and depositors, both individuals and institutions, pension funds, insurance companies, and so on. Let's have a look at the Federal Reserve's balance sheet. Federal Reserve System has as its liabilities the currency in circulation and the reserves that banks hold with it. Its assets are securities, government bonds, and so on, and loans it makes to financial institutions. The liabilities is the currency in circulation, again reserves the bank deposits at the Fed involve cash, assets, government securities, and also corporate securities, which are holdings by the Fed that affect the money supply and earn interest. And the loans are usually discount loans providing reserves to banks, and these loans earn the rate of discount. Let's consider the case if the Federal Reserve purchases the securities, the bonds from the non-bank public, which could be a wealthy individual, an insurance company, a corporation, and so on. There's two possibilities. First, the person selling the bonds to the Federal Reserve deposits the Fed's check in the bank or makes an automatic transfer. This creates an identical result as the purchase from the bank. Federal Reserve has 100 million liabilities. It has the assets, which are securities, 100 million. There are liabilities of the banking system, while the checkable deposits of 100 million, and the reserves are their assets of 100 million. Or, what happens if the person selling the bonds cashes the Fed's check? Well, the reserves are unchanged. The currency in circulation increases by the amount of the open market purchase, the 100 million, and the monetary base then increases by the amount of the open market purchase, so currency in circulation increases by 100 million. So open market purchase, the effect of an open market purchase on reserves depends upon whether the seller of the bonds keeps the proceeds from the sale in currency or in deposits. The effect of an open market purchase on the monetary base always increases the monetary base by the amount of the purchase. What about an open market sale of bonds? An open market sale of bonds, in contrast, reduces the monetary base by the amount of the sale. Reserves remain unchanged. The effect of the open market operations on the monetary base is much more certain than the effect on reserves. Shifts from deposits into currency. The net effect on monetary liabilities is zero. Reserves are changed, in this case by random fluctuations, and the monetary base is a relatively stable variable. What about loans to financial institutions, which the Federal Reserve can make? In this case, monetary liabilities of the Fed have increased by 100 million because they've loaned to financial institutions. The liabilities of the banking system have increased by 100 million because they're actually borrowing from the Fed. And the monetary base also increases by the same amount. So let's look at an overview of the Fed's ability to control the monetary base. So open market operations, the buying and selling of securities, are controlled by the Federal Reserve. The Federal Reserve can determine the amount of borrowing by banks from the Federal Reserve. They can determine how much the banks are allowed to borrow. If we split the monetary base into two components, the monetary base is equal to the non-borrowed monetary base and the level of borrowed reserves, BR, then the total monetary base is MBN plus BR. And the money supply is positively related to both of them. Let's do a simple model of multiple deposit creation. We have one bank. In this case, we have an increase in excess reserves. The bank loans out the extra reserves to its customers, creating a checking account. The borrower from the bank then makes purchases, and the money supply is increased by the amount of the loans. And this feeds into Bank B, which then actually have an increase in their reserves. They then lend out and create checkable deposits of 90 million, assuming 10% of reserves, keep their reserves of 9 million, and make 81 million of loans. And so the process goes. So the creation of deposits, assuming a 10% reserve requirement and a $100 increase in reserves, we'll see for different banks from A to F, we see the increase in reserves, the increase in deposits, the increase in loans, and therefore the increase in the money supply. And this is just looking at the whole process that we did look at last week, but seeing how the Federal Reserve can spark the process off. What's the formula for multiple deposit creation? Assume that first that banks don't hold any excess reserves. The assumption means that the total amount of required reserves equals total reserves. So the total reserves are the required reserves by the system. The total amount of required reserves equals the required reserve ratio times the amount of checkable deposits, D. So RR, the total amount of required reserves, equals RR multiplied by D. Rearranging the equation, we have the checkable deposits equals the reserves divided by RR. Taking the change in both sides of the equation and using delta to represent the changes, the change in deposits will equal the change in reserves divided by RR. How can you criticise the simple model? If anybody holds cash, the process stops. So currency has no multiple deposit expansion. Currency will not increase deposits, only reserves. Banks may not use all of their excess reserves to buy securities or make loans. Depositors' decision how much currency to hold, and banks' decision how much of the amount of their excess reserves to hold or to lend out, also causes changes in the money supply. So the simple model is, as it says, simple, but all sorts of things can interfere with the process. Changes in the non-borrowed monetary base, MBN. The money supply is positively related to the non-borrowed monetary base. Changes in borrowed reserves from the Fed. The money supply is positively related to the level of borrowed reserves from the Fed. Changes in the required reserves ratio. The money supply is negatively related to the required reserve ratio. If the reserve ratio required by the Fed increases, the money supply will decrease. Changes in currency holdings. The money supply is negatively related to currency holdings. As soon as it's held in currency, money is taken into currency, then this will reduce the money supply creation process. Changes in excess reserves. The money supply is negatively related to the amount of excess reserves. So if banks decide to hold reserves greater than what they're required to do, this will have a negative impact on the money supply, which of course is what has happened as the money supply has expanded during the period of quantitative easing. At the same time, uncertainty and increasing bank regulations have made banks less willing to lend out and led to excess reserves, which reduces the money supply creation process. So, summarising it, got the players, the Federal Reserve System, the banks and depositors. We've got variables, non-borrowed monetary base, required reserve ratio, which is from the Fed, borrowed reserves, excess reserves, and currency holdings. And this shows that changing any of these variables, if it goes up, what the impact on the money supply is. So if the non-borrowed monetary base goes up, the money supply goes up. If the required reserve ratio goes up, the money supply response is to go down. Borrowed reserves goes up, the money supply goes up. If banks want to hold excess reserves, that pushes the money supply down. Less loans and deposit creation. If currency holdings increase, then that will decrease the money supply because there's less multiple deposit expansion in the system. So let's look at the simple money multiplier. Define money as a currency plus checkable deposits, M1. So we link the money supply M to the monetary base, MB, and let M be the money multiplier. So the total money supply is M multiplied by the monetary base. Assume that the desired holdings of currencies C and excess reserves ER grow proportionally with checkable deposits D. Then we have a currency ratio. How much of the deposits are taken out in currency. We have E, which is C. Then we have E, which is an excess reserve ratio. The total amount of reserves equals the sum of required reserves and excess reserves. So the total reserves in the system is what the Federal Reserve requires banks to hold, plus any excess reserves which they wish to hold. The total amount of required reserves then equals the required reserve ratio times the amount of checkable deposits. RR equals small rr multiplied by D. Substituting for RR in the first equation gives R equals RR multiplied by D plus excess reserve. The monetary base MB then equals currency plus reserves. So monetary base equals C plus R equals C, substituting in RR multiplied by D in brackets plus excess reserves. And this equation reveals that the amount of the monetary base needed to support the existing amounts of checkable deposits, currency and excess reserves. And these are just some, you can look at your leisure, some aspects of the formula. Making various substitutions gives you the final definition of the money multiplier. 1 plus C divided by R plus E plus C. What's the intuition behind the money multiplier? Little r is the required reserve ratio, which is set by the Fed. Large C is the currency in circulation, let's call it 400 billion. And the required reserve ratio, let's say it's 10%, 0.1. Let's say there's 800 billion of checkable deposits. Let's say there's 0.8 billion of excess reserves, ER. So the money supply, M1 equals C plus D, which is $1.2 trillion. Little c is 400 billion divided by 800 billion is 0.5. Little e is 0.8 billion divided by 800 billion, which is 0.001. So the money multiplier in that case is 1 plus 0.5 divided by 0.1 plus 0.001 plus 0.5, which comes to 2.5. This is obviously less than a kind of simple deposit multiplier where you just look at the reserve ratio and go through the system. So a 10% reserve ratio would actually lead to 10 times, 25% reserve ratio 4 times, but this is obviously less because of it looks at the multiple expansion of deposits, and it looks at questions like currency and excess reserves, which are leakages out of the system. Let's look at some data now. This is from the Federal Reserve Bank of St. Louis, which is one of the regional members of the Federal Reserve System. If we look from 2007 to 2017, and we look at M1 and the monetary base, you see that the monetary base was well below M1 in the period leading up to the financial crisis, and then the monetary base increased above that in the following years. Let's look at the excess reserves ratio and the currency ratio. Currency ratio small c going down over the same period, but we see a large increase in the excess reserves ratio. Remember, this is the reserves which banks are holding more than is necessary, more than is required by the Federal Reserve System. Now, this may be because they're expecting regulatory changes, or maybe because of the feeling under stress, or maybe because of uncertainty. But the implication of this is that the excess reserves ratio goes up, as we saw, the money supply goes down, and this has a depressing impact on the economy. With the understanding how the Federal Reserve can impact on banks' reserves, and how reserves impact on the money supply, I want to look now about the relationship between reserves and interest rates. So we'll see how the market for reserves, and we'll see how changes in monetary policy by the central bank, and in this case the Federal Reserve, can affect the federal funds rate. And as we know, the federal funds rate is one interest rate, but this will affect, as we saw in the previous week, the entire term structure of interest rates, as we saw in week 2. We'll summarise how conventional monetary policy tools are implemented, and the advantages and limitations of each tool, and we'll explain the key monetary pools that are used when conventional policy is no longer effective, as has happened in Japan after the late 90s, and has happened increasingly with the central banks of the ECB, Bank of England, the Fed, and also the Bank of Japan after the financial crisis, and increasingly now with the need for monetary loosening because of the COVID crisis. Conventional monetary policy tools of the Federal Reserve. During normal times, the Federal Reserve uses several tools of monetary policy: open market operations, discount lending, and reserve requirements to control the money supply and interest rates, and these are referred to as conventional monetary policy tools. Open market operations, buying and selling securities. Dynamic open market operations are intended to change the reserves in the banking system and the monetary base. Defensive open market operations, repurchase agreements, match sale, purchase agreements, reverse repo, dealing with primary dealers, or traps. Traps are open market operations conducted electronically with specialist dealers in government security, known as primary dealers, and the computer system which is carried out as known as traps. Discount policy and lender of last resort. There are 3 types of federal discount rate loans to banks: Primary credit, a standing lending facility. Healthy banks are allowed to borrow all they want at very short-term maturities, and the rate is usually set 1 percentage point higher than the federal funds rate target. Secondary credit, seasonal credit, and finally, lender of last resort to banks with liquidity problems to prevent financial panics. Of course, this creates a moral hazard problem, the danger that banks will actually make irresponsible decisions knowing that the Fed will act as a lender of last resort. Reserve requirements. Depository Institutions Deregulation and Monetary Control Act of 1980 sets the reserve requirements for the same rate for all depository institutions. Reserve requirements is what banks have to keep in reserves are equal to zero for the first 15.5 million of a bank's checkable deposits, 3% on checkable deposits from 15.5 to 115.1 million, and 10% on checkable deposits over 115.1 million. And the Fed can vary this requirement between 8% and 14%. Interest and excess reserves. The Fed started paying interest on excess reserves only in 2008. It used to provide a floor under the federal funds rate. The interest on excess reserves tool came to the rescue during the financial crash, as banks were accumulating huge quantities of excess reserves because it could not be used to raise the federal funds rate. Relative advantages of the different monetary policy tools. Open market operations, in other words buying and selling securities by the Federal Reserve, are the dominant policy of the Fed. Since it has complete control over the volume of the transactions, the operations are flexible and precise, they can be easily reversed and become quite quickly implemented. The discount rate is less well used since it is no longer binding for most banks. It can cause liquidity problems and it increases uncertainty for banks. So the discount window remains of tremendous value given its ability to allow the Fed to act as a lender of last resort, but it is not used as frequently. When the economy experiences a full-scale financial crisis, as in 2008 to 2009, conventional monetary policies cannot do the job for two reasons. First, the financial system seizes up to such an extent and experiences enormous liquidity problems that it becomes unable to allocate capital to productive uses, and so investment spending leads to a potential collapse in the economy. Second, the negative shock to the economy can lead to the zero low bound problem. In other words, interest rates are reduced so low that they no longer have any effect, and you can't actually reduce them below zero very easily. So there were non-conventional monetary policy tools which were used during the global financial crisis. First, liquidity provision. The Federal Reserve implemented unprecedented increases in its lending facilities to banks and financial institutions to provide liquidity to the financial markets. It expanded the discount window enormously. The term auction facility created new lending programs, and then it made very, very large-scale asset purchases. During the crisis, the Fed started 3 new asset purchase programs to lower interest rates and provide liquidity for a particular type of credit. The government-sponsored Entities Purchase Program, QE2, Quantitative Easing 2, and Quantitative Easing 3. Asset purchases are, in a sense, the same principle as open market operations, but at a very enhanced scale. And here we can see the expansion of the federal balance sheet during the period 2007 to 2014. Effectively, what the Fed does is credit itself to be able to make the purchases. So if we see these, what actually happened, we've got billions of dollars on the vertical axis, we've got time on the horizontal axis. You can see traditional security holdings, in other words open market operations, they were set aside in the period. As we enter the financial crisis, the balance sheet of the Fed expands enormously, and you can see first lending, the blue line. Then early 2010, the Fed starts on long-term Treasury purchases, quantitative easing, and then we have Fed agency debt and mortgage-backed securities purchases coming in again to around in 2009 and expanding quite significantly. Then we see an expansion of the Fed's balance sheet from just under 1 trillion in 2007 to over between 4 and 5 trillion by 2014. Quantitative easing versus credit easing. The Fed's policies were directed not at expanding the balance sheets, but rather at credit easing. The expansion was not, although the Fed's balance sheet did expand, the idea was to ease the credit conditions. That is, altering the composition of the Fed's balance sheet in order to improve the function of particular segments of the credit markets, in other words, banking, the money markets, and the mortgage-backed securities market. Forward guidance: by committing to the future policy action of keeping the federal funds rate at zero for an extended period, the Fed could lower the market's expectations of future short-term interest rates, thereby causing long-term interest rates to fall. So the Fed was effectively saying we're going to keep interest rates close to zero, short-term interest rates for some time, which allows this then to ripple through the term structure of interest rates and keep long-term interest rates down to assist borrowing to recover. Negative interest rates on bank deposits. Setting negative interest rates on bank deposits is supposed to work to stimulate the economy by encouraging banks to lend out the deposits they were keeping at the central bank, thereby encouraging households and businesses to spend more. So the banks are encouraged not to hold deposits at the central bank, instead to lend them out. However, there are some doubts that negative interest rates on deposits will actually have the intended expansionary effect. When the global financial crisis began at the autumn of 2007, the Fed initiated, as we saw, it expanded its balance sheet, initiated lending programs and large-scale asset purchases in an attempt to bolster the economy. By the autumn of 2017, these purchases had led to a quintupling of the Fed's balance sheet and a 350% increase in the monetary base. But this has not led to any noticeable uptick in inflation. And of course, we're now in a situation where the balance sheet has increased yet again because of the monetary response to the COVID-19 crisis. The lending and asset purchase programs resulted in a huge expansion of the monetary base, and they were given the name, as we're all familiar now, as quantitative easing. But this increase in the monetary base did not lead to an equivalent change in the money supply, because excess reserves held by banks rose dramatically. As we saw, if excess reserves rise, this does not have tends to reduce the money supply. Well, we'll look now a bit more detail at the goals and strategies of central banks. Well, what do we expect to understand from this section of the lecture? We're going to define and recognise the importance of a nominal anchor in monetary policy. We'll identify the 6 potential goals that monetary policy makers may pursue. Summarise the distinctions between hierarchical and dual mandates. compare and contrast the advantages and disadvantages of inflation targeting as a policy, identify the key changes made over time to the Federal Reserve's monetary policy strategy, list 4 lessons learned from the global financial crisis and discuss what they mean to inflation targeting, summarise the arguments for and against central bank policy responses to asset price bubbles, and describe and assess the 4 criteria for choosing a policy instrument. Finally, interpret and assess the performance of the Taylor rule as a hypothetical policy instrument for setting the federal funds rate. Price stability goal and the nominal anchor. Over the past few decades, policymakers at central banks throughout the world have become increasingly aware of the social and economic costs of inflation, especially after the experience of the 1970s and early 80s. And therefore more concerned with maintaining a stable price level as a primary goal of economic policy. This has led to the role of a nominal anchor, and nominal variables such as the inflation rate or the money supply, which ties down the price level to achieve price stability. The whole point is to actually anchor expectations of either a growth in the money supply or a target for inflation. There is, of course, the time inconsistency problem, pointed out by many economists, that to be believable, the Federal Reserve or the monetary policy authorities have to be consistent. What are the possible 5 other goals of monetary policy? Well, 5 other alternative goals are continually mentioned by central bank officials when they discuss the objectives of monetary policy. 1 is high employment and output stability, to achieve the full level of full employment, which is known as the natural rate of unemployment, a theoretical concept which is the rate of unemployment which exists when the output in the economy is at its full potential rate of output. Secondly is consistent and stable economic growth. The Bank of England has been looking increasingly, for example, at the problems of productivity and low growth in the British economy. A third objective is to ensure the stability of financial markets. Increasingly, central banks have become worried about the potential impact of climate change on financial markets. Interest rate stability. Major or volatile fluctuations in interest rates create uncertainty for financial institutions, and it's best to keep interest rates reasonably stable. And then finally, stability in foreign exchange markets. The need to have not major appreciations or depreciations in the currency. The Central Bank of Turkey has been having to deal with fluctuations in the value of the Turkish lira, which is worth looking at if you get a chance to look it up. Should price stability be the primary goal or the first goal of monetary policy? Well, this brings in the question of hierarchical versus dual mandates. Hierarchical mandates put the goal of price stability first, and then say as long as that is achieved, other goals that can then be pursued. So that has to be the primary goal, and other goals are secondary. Dual mandates are aimed at achieving 2 equally important objects, for example, price stability and maximum employment, or output stability, keeping output as close as possible to the potential, and unemployment at the natural rate of unemployment. The Federal Reserve is much more concerned with these dual mandates. The European Central Bank much more with price stability. Price stability is the primary long-run goal of monetary policy. Either types of mandates are acceptable as long as it operates to make price stability the primary goal in the long run, but not necessarily the short run. Attempts to keep inflation at the same level in the short run can cause excessive output fluctuations. In other words, if we try to actually, in the short run, bring inflation down, we could actually reduce output in the economy too quickly. Inflation targeting. Inflation targeting involves several elements. First, public announcements of medium-term numerical target for inflation, which hopefully solve the time inconsistency problem. These are meant to anchor expectations. Institutional commitment to price stability is the primary long-run goal of monetary policy and a commitment to achieve this inflation goal. For example, this is in the Bank of England's mandate, where if they do not achieve the 2% rate of price increases, inflation, a letter has to be written, which is published to the Chancellor of the Exchequer. An information-inclusive approach in which many variables are used in making decisions: the housing market, employment, confidence indicators, for example, like the PMI, the Purchasing Managers Index, the exchange rate, and so on, and an increased transparency of what the central bank's policy is based on. Experiences with inflation targeting. In New Zealand, inflation targeting became effective in 1990. Inflation was brought down and remained with the target set by the central bank of New Zealand most of the time. Growth has been generally high and unemployment has come down significantly. Canada began in 1991. Inflation decreased since 1981, but there has been some costs in terms of unemployment. The United Kingdom began inflation target in 1992. Inflation has been close to its target. Growth has been relatively strong and unemployment has been decreasing until the period of austerity after the financial crisis, when growth has been somewhat disappointing. Let's look at the data and experience in graphical forms. Here we have the inflation rates and inflation targets for New Zealand, Canada, United Kingdom, 1980 to 2017. We have the period, the green line is when inflation targeting begins. You see more volatile and higher average rates of inflation before that for the three countries. And then we actually show the target range in the horizontal green lines and in the dotted green lines, the midpoint, and you see how generally the countries have been fairly successful. There were some problems with the United Kingdom from 2015 when inflation starts to actually go well below its target. We don't look at the European Central Bank, but the European Central Bank has actually generally been finding inflation below its target since the financial crisis. What are the advantages of inflation targeting? Well, reduction of the time inconsistency problem, which cast doubt on the commitments of governments or central banks. There's increased transparency, increased accountability. It's consistent with democratic principles. Obviously, there's been improved performance. Disadvantages: delayed signalling of changes in monetary policy, too much rigidity if the target is wrong, for example, potential for increased output fluctuations in lieu of price fluctuations, and low economic growth during periods of disinflation. Let's look at the evolution of the Federal Reserve's monetary policy strategy. The United States has achieved excellent macroeconomic performance, including low and stable inflation, until the onset of the global financial crisis of 2007, 2008, 2009. It used an explicit anchor, such as an inflation target. In 1975, the Federal Reserve began to announce publicly targets for money supply growth in line with Friedman's monetarist argument. In 1979, Paul Volcker, as Federal Reserve Chairman, focused more on targeted non-borrowed reserves. In 1993, Alan Greenspan announced that the Federal Reserve would stop using monetary aggregates as a guide for conducting monetary policy. There is no explicit nominal anchor in the form of an overriding concern for the Fed. Forward-looking behaviour and periodic preemptive strikes in case inflation is getting out of hand. The goal is to prevent inflation from getting started. What's the advantages? The Federal Reserve uses many sources of information. There's been a demonstrated success. What's the disadvantages? Well, there's been a lack of accountability. There's been no predetermined criteria for judging the Federal Reserve's performance, and it is inconsistent with democratic principles. The Fed's policy regime has often been described as a just-do-it policy. Global financial crisis. What's the advantage of the Fed's just-do-it approach? Well, forward-looking behaviour and a stress on price stability helps to discourage overly expansionary monetary policy, thereby ameliorating the time and consistency problem. About commitment. Disadvantages of the Fed's just-do-it approach. Lack of transparency for the lack of an explicit nominal anchor. Strong dependence on the preferences, skills and trustworthiness of the individuals in charge of the central bank. And there's a very much of an emphasis in the financial press in the US about the personalities of the central bank governors, chairman and governors. Inside the Fed, let's look at Ben Bernanke's advocacy of inflation targeting. Before Ben Bernanke became Federal Reserve Chairman, while a professor at Princeton, Bernanke, in several articles and in a book co-written with Mishkin, who is the textbook for this course, argued that inflation targeting would be a major step forward for the Federal Reserve and would produce better economic outcomes for many of the reasons we've outlined earlier. When Bernanke took his position as governor of the Federal Reserve from 2000 to 2005, and then later chairman, he continued to advocate the adoption of an inflation target. The European Central Bank has been slower to move towards inflation targeting, adopting a hybrid monetary strategy that includes a little bit of the element of inflation targeting. Strategies and lessons from the global financial crisis. Developments in the financial sector have had a far greater impact on economic activity than was earlier realised. An impact which we have to go back to 1929 to see anything similar. The zero lower bound problem on interest rates can be a serious issue. The cost of cleaning up after a financial crisis can be extremely high, and as in the period of the Great Moderation, price and output stability, which happened in the decades before the financial crisis, do not ensure financial stability. This has always been a question: should central banks respond to bubbles? How should central banks respond to asset price bubbles? What is an asset price bubble? It's a pronounced increase in asset prices that depart from fundamental values which eventually burst. One previous Federal Reserve chairman argued that it was the case of raising interest rates while it was a bubble was like taking a punch away from a party before the party got going. What type of asset price bubbles are they? Credit-driven bubbles like the housing price bubble, bubbles driven solely by overly optimistic expectations, often dubbed irrational exuberance, for example at the tech stock bubble of the internet in the start of the 21st century. Well, there's a strong argument for not responding to bubbles which are driven by irrational exuberance, let them deflate themselves. Bubbles are easier to identify when asset prices and credit are increasing rapidly at the time, and there's a strong argument that monetary policy should keep to its normal objectives and not be used to prick bubbles. Macroprudential policy. Central banks often are involved with macroprudential policy, which is regulatory policy to affect what is happening in credit markets in the aggregate, not looking at interest rates, the pricing, but making sure there's adequate disclosure, capital requirements, prompt corrective actions, and close monitoring of financial institutions' risk management procedures, which is what the Bank of England does now, following the financial crisis. Monetary policy, the problem was in the Great Moderation, when Alan Greenspan was Federal Reserve Chairman, low interest rate policies were followed by excessive risk taken by banks and shadow banks, suggesting that overly easy monetary policy can cause financial instability. This channel also suggests that monetary policy should be used to lean against credit booms, although not necessarily prick them. Tactics, choosing the policy instrument. Well, the tools available to central banks are obviously open market operations, reserve requirements and the discount rate, and they are operating policy instruments, which is reserve aggregates, interest rates, and linking possibly inflation or rates to an intermediate target. Must be noted that interest rate and aggregate targets are incompatible. One must be chosen or the other, not both. Let's look at the linkages between central bank tools, policy, instruments, intermediate targets, and the goals of monetary policy. Tools of the central bank: open market operations, discount policy, reserve requirements, the interest paid on reserves, large-scale asset purchases or quantitative easing, forward guidance. Policy instruments: reserve aggregates, reserves, non-borrowed reserves, the monetary base, non-borrowed base, short-term interest rates. Intermediate targets is to affect monetary aggregates like M1 or M2, or interest rates, the term structure short and long term. And the goals are price stability, high employment, economic growth, financial market stability, interest rate stability, and foreign exchange market stability. Well, what are the main criteria for choosing the policy instrument in a central bank? The observability and measurability of the instrument and its results, how controllable it is, the money supply, the monetary base, the reserve requirements, and so on. What is the predictable effect on goals, which is based upon past observation and possibly using econometric models. One particular tactic which we'll look at has been named the Taylor rule. John Taylor, the economist, argued that the federal funds rate target should equal the inflation rate plus the equilibrium real Fed funds rate plus half the inflation gap plus half the output gap. And we'll explain what these mean. An inflation gap and an output gap. Stabilizing real output is an important concern. The output gap is an indicator of future inflation, as shown by the Phillips curve. And NIRU, non-accelerating inflation rate of unemployment, the rate of employment at which there will be no tendency for inflation to change. And here's the Taylor rule and the federal funds rate. What over a particular period the federal funds rate actually was, and what the Taylor rule would have predicted it should have been, given the policy objectives of closing an output gap or closing an inflation gap. And let's have a look. In the 70s, the federal funds rate was actually lower than the Taylor rule said it should be. But in the period of the Great Moderation, we have an interesting case in which the federal funds rate, in some cases, and then especially after the financial crisis, has been lower than what the Taylor rule predicted it should have been. The Fed's use of the Taylor rule, putting monetary policy on an autopilot by using the Taylor rule with fixed coefficients is problematic. Even though it's been recommended, it's useful as a guide to monetary policy, but very, very few people would actually believe that the Federal Reserve Chairman should set the rules by an equation. So John B. Taylor first observed what he called the reaction function of a central bank's monetary policy. And what does the Taylor rule look like? If the effects were acceptable in terms of low inflation and low output gap, this would indicate proper conduct. He then proposed the rule in 1993, discretion versus policy rules. And in particular, the rule is that the nominal federal funds rate should be equal to R plus which is the real federal funds rate, usually around about 2%, plus the rate of inflation, plus half the difference between the rate of inflation and the target rate of inflation, and half the difference between the logarithm of potential output and the logarithm of real output. So half and half is playing an equal amount on interest rate policy deciding whether or not inflation is above or below target, and half of it being whether or not output is above or below target. So this was the argument for the how the Taylor rule should be set.